welcome to The Point World Affairs. I'm Taesang Lee. The global economy is facing a difficult challenge. With its two main pillars, the United States and China, locked in a bitter trade dispute, while the Federal Reserve's interest rate hike is setting off alarm bells in the emerging markets. Today, we take a closer look at the Fed's latest rate hike and its possible impact on emerging economies, including China, and the outlook of the trade dispute between Washington and Beijing. For that, we have with us Daniel Yu, head of the global strategy team at Kiwoom Securities. Thank you for joining us today.
Thank you for having me.
Let's first take a look at this short clip.
The U.S. Federal Reserve has hiked its benchmark interest rate for the third time this year. While the Fed says the rate hike comes at a good time when the economy is growing, President Trump is unhappy about the decision, saying it may cool down the economy. Despite the president's blatant complaints, the U.S. Central Bank said it may raise its benchmark interest rate a total of 4 times by next year. But if that were to take place, many experts worry that emerging economies around the world will face pressure from a strong dollar and the trade dispute between the world's two biggest economies. In fact, as countries like Argentina, Turkey, and Brazil have yet to stabilize their currencies, many are closely following the impact of a persistent rate hike in the U.S. China, in particular, is facing another crisis from the Fed's decision, on top of the sagging growth that it has been seeing due to the trade dispute. If the gap in interest rates between the U.S. and China narrows, the dollar strengthens while the yuan weakens, the possibility of capital outflow in China will increase. In response, the Chinese government is working on measures to prevent this from happening. On this week's The Point World Affairs, we take a look at how the economies of the U.S. and China are being affected from the rate hike and trade dispute, while evaluating how this will potentially impact the global economy.
The Federal Reserve, they have hiked the interest rate 3 times this year. So it seems like President Trump is not very fond of this idea. But why did the Fed have to do that this time?
Right. Of course, Trump is not happy with this, but you have to understand what Fed stands for. The Fed has to control inflation while having a stable economic growth rate. If you look at the inflation numbers, you have seen quite a significant jump this year. You had inflation going up to 2.9% in July, and also, more importantly, the core inflation went up to 2.4%, which is well above 2% target of Fed. Fed has to raise interest rate, of course. The key question mark is that what's going to happen to this inflation number going forward? If you look at August number, the number is coming down slightly. So the base effect is actually disappearing. So therefore, inflation might slow down towards the end of this year. If that happens, then maybe Fed will slow down in terms of interest rate hike. Right now, everybody expects that December will be another interest rate hike. But if the inflation goes down to 2% level in core inflation, then interest rate rise will slow down in the future.
Right, even though there are a lot of impacts, some commentators say that Asian market will actually not get impacted that much from the Fed's interest rate hike because now the reliance on the economy has shifted from the United States to China. So the Asian market would actually, it doesn't matter for the Asian market. So what's your take on that?
Right. Unfortunately, still, the China overall yuan, currency-wise, it is only about 5% of the global trade numbers. If you look at the international settlement numbers, the payment numbers, it is only 2.5%. So it's very small. So yes, we are seeing these numbers as of end of 2016. We don't have the numbers yet until for 2018. But if you remember, China has started something called the Belt and Road policy. So therefore, the dependency of Asian countries has risen. I think that number might have gone up to as high as 5% plus. Some might say it's a 10%. If that's the case, yes, there will be a little bit less impact to the Asian countries due to the dependency on China. I think this is why Trump is actually tackling Chinese yuan as well as Chinese economy.
Right. So speaking of China, if we focus on China a little more, we hear that there has been increased capital outflows from China. Is this actually closely connected to the tensions with Washington, or why is this so?
Right. Some people say that China is under big trouble. Yes, there is possibility of the trouble, but still the economic growth rate is well above 6.8%. But the key concern is there are 3 points. Number one is that U.S. and China is having a trade war or trade dispute, which will impact Chinese economy. The second thing is also there's a very significant slowdown of fixed asset investment. And the third issue is that what's happening to the debt level of China, which is very high. So the concern is that if the outflow continues, then this will impact significantly on China. China will go to a hard landing, and this will be a disaster point. If you look at the capital outflow numbers, at the peak, China had $4 trillion of reserve, but that was on 2014. Now it's only 3.1 trillion, so 25% has disappeared. So people are worried about that. But nevertheless, we have to look at not just the foreign reserve, but what is the external debt amount. External debt amount is only half of the reserve that China has. So therefore, everybody takes the money out, still they will have quite significant amount of dollars left. So this is why I think that China is not going to go through a significant crisis. But nevertheless, it really depends on how government will react to the, what U.S. is doing. If they're increasing the consumption base, then they will be able to wither this out quite well. I think that the question mark is how fast they can grow their domestic consumption market.
Right, so it's really hard to judge one country's economy just by looking at one figure or just one side of the economy,
Sure.
right? So let's connect to local experts to find more about it.
The trade war between the U.S. and China is escalating. On September 24th, the United States imposed an additional 10% tariff on roughly $200 billion worth of Chinese imports. In response, China also slapped a 5 to 10% retaliatory tariff on $60 billion worth of U.S. products. In total, the U.S. and China have imposed tariffs on products worth roughly $250 billion and $110 billion, respectively, including figures from July and August. President Trump has also expressed his will to press China until it surrenders in a speech at the UN General Assembly.
They engage in relentless product dumping, forced technology transfer, and the theft of intellectual property. The United States lost over 3 million manufacturing jobs, nearly a quarter of all steel jobs, and 60,000 factories after China joined the WTO.
While China is seeking opportunities for negotiation in the short term, it also seems to be preparing for a protracted conflict with the U.S. President Xi Jinping recently emphasized the importance of economic independence, saying that the trade friction with the U.S. is not necessarily bad. He has also taken measures to reduce the tariff rate on 1,500 import products. As China realizes this trade dispute with the world's largest economy may be a lengthy and protracted issue, it's determined to overcome the crisis through self-reliance instead of succumbing to U.S. pressure. On the other hand, many experts say that tension with China will not bode well for the U.S., as American consumers will suffer direct damages from the high cost. With both countries showing no signs of retreat, we connect with experts from both the U.S. and China to study the deepening U.S.-China trade dispute.
Let's connect to an expert in the U.S. for more analysis. We have Victor Shi, professor at the School of International Relations and Pacific Studies at UC San Diego. Good to have you on, Professor Shi.
Thank you for having me.
Right, some experts say that the continued tension with Beijing and Washington will actually impact the American consumers. So what's your take on that, and what is the local sentiment there in the United States?
It's undeniable that tariff is a tax, and is a tax on consumers. So any tariffs, imposed by the U.S. government will lead to higher prices for American consumers. And given the scope of the trade war, the U.S. is levying tariffs on $260 billion worth of Chinese goods that used to be exported to the United States at very low tariffs or even no tariffs, suddenly there's 10% tariff. So for the same good, American consumers will have to pay higher prices. It may not be 10% because the sellers, like Walmart or whoever is selling Chinese goods, may decide to eat some of the costs themselves and still offer relatively low prices. But then, the chances that American consumers will have to pay higher costs. But, I think it doesn't mean that it's totally a bad deal for American consumers or American citizens in general. Basically, China also has been violating a lot of norms of international trade in the past 20 years. And to send a credible signal to really tell the Chinese government that the U.S. is serious, the U.S. Has to do something like that. I think a tariff on $200+ billion worth of goods, probably not the best thing to do, but something like that was needed to send a believable and serious signal to the Chinese government that it has to change some of the things that it has been doing. The local sentiment here, I would say, is so far people are not very alarmed in the United States because the U.S. economy is doing great so far. That could change in the next months or something like that, and then things would be very different. But so far, unemployment is very low, and because most people have a job, they're not bothered by higher prices that much.
Right, Professor, there's been rather two very different interpretations of this trade dispute between Beijing and Washington. And one side says that this will actually trigger financial crisis within China. But the other side of the commentators say that this will actually impact Chinese economy maybe by 2030. But later on, China will become #1 economy in the world. So who do you agree with a little more?
Even though for economic growth, net export is not that important, for the balance of payment, so balance of payment is just how much money flow into and out of China, export actually is very important. So as you know, back in 2015, $1 trillion left China. So the Chinese foreign exchange reserve declined by $1 trillion in 2015. That was a huge shock to balance of payment of China. And one of the only things that really helped China weather that shock in 2015 was the fact that it ran trade surplus month after month, $30 to $60 billion worth of trade surplus. And over time, through running trade surplus and more capital control, the Chinese government was able to stabilize the foreign exchange reserve to $3 trillion. But imagine if the trade war with the United States even changes the trade surplus by not that much, by $20 or $30 billion per month, let's say, which, you can say, wow, but China exports, whatever, trillions of dollars of goods. It doesn't really matter. But another way of thinking about this is that even though China has run trade surplus every month, the foreign exchange reserve of China has not increased at all in 2017 or 2018 so far. It has been completely flat. That means a lot of money has been leaving China in the past couple of years that only the trade surplus has managed to stabilize the foreign exchange reserve. If the trade surplus was to shrink because of the trade war, even by, let's say, $30 billion per month, over the course of 10 months, that means $300 billion less in China's foreign exchange reserve. That's very substantial and could trigger another round of panic capital flight from China. So I think, even kind of modest shrinkage of China's monthly trade surplus could potentially be a very substantial blow to China's balance of payment.
Thank you, Victor Chi from UC San Diego. Daniel, so a lot of experts say that this could actually negatively impact the U.S. if they continue to pressure China. So what's your take on that?
Right. I think it really depends on what happens to the inflation number. If you look at so far the tariff amount that went up, it's about 25% of the 50 billion goods and services, and then 10% of 200 billion. So if you add all that up, what it comes out to be is about 0.2% of total U.S. consumption. That's very small amount of number. So it's not going to really impact the inflation as much as people are worried about. But if Trump goes all the way and decides to do 25% tariff on all 500 billion plus worth, that impacts 0.5% of the overall consumption. Now, the question mark now, though, is that if this happens, all the tariff happens, then inflation will rise, and therefore the Fed will raise interest rate fast, and which is not going to be good for Trump. Right now, Trump is having a very tough stand on China, is winning the votes, right? The Republicans are winning on that, but with the recent scandals and a lot of issues, the poll numbers came through, and that number says the Democrats are 52%, and the Republicans only 38%. There's a 14 percentage point differential, which is big. So until the mid-election, which is the November 6th, I think Trump will keep push for this. But he bought some time and saying only 10% until the end of the year. So depends on how China reacts. He will decide on keep going into the 25% or not. For the time being, though, I think that this is not that significant amount of inflationary pressure.
Okay, let's connect to an expert in Beijing and hear more about it.
Okay.
China, emphasizing economic independence, seems to be preparing for a lengthy, protracted conflict with the United States. Let's now connect to an expert in Beijing, Xu Chenggang, a professor at the Chengkang Graduate School of Business. Welcome, Professor Xu.
My pleasure.
Chinese President Xi Jinping recently said that the trade dispute with the U.S. will only help develop China and that it's not a bad phenomenon. What's your take on that?
Right. For understanding this issue, I guess it's better to look at the recent history. So when China was insulated itself from the international communities, China was very backward. So it includes the time in the late 19th and early 20th century, and particularly right before the Chinese opening up, before the economic reform. The so-called economic reform is intimately related to opening up. So when China was isolated from outside of the world, China was extremely backward, and China was one of the poorest countries in the world. So the recent more than 3 decades of growth has been inseparable with opening up. So which means that isolating from outside of the world is going to hurt China.
So what is China's current stance on this issue, and how is the Chinese government reacting or responding to this ongoing trade dispute?
When the focus was narrowed down to responding to whatever the American side has taken, then that would not work. And it's exactly because this is not just a trade dispute. This is about all the major promises that the Chinese government has made since China joined the WTO. And among these promises, it includes reducing the government intervention, reducing the entry barriers, protecting intellectual property rights, and further opening up to the international markets in all the major sectors. So these are promised at that time. And fulfilling these promises are not only important in terms of WTO, these are much more important for the Chinese economic reform itself. The better responses should be doing more in that direction. But currently, you see more measures directly in a response to the tariffs. And on the other hand, there is a Chinese currency depreciation. Either is related to this or not. There are different views, but the reality is that there is a depreciation of the Chinese currency. But at the end of the day, the tariffs and the depreciation of the currencies, these are not recipes for solving the problems.
Thank you. That was Professor Xu Chenggang in Beijing. Now, Daniel, it seems like there are a lot of changes inside China as well. But, you know, when we talk about China's economy now, there are a lot of concerns growing outside China about what if there is the Chinese economy collapses, and it will blow a huge deal to the entire global economy. So what do you think about this?
Well, if you think about it, it's very simple. You're looking at 16% of the global economy growing at 7% right now. But if it slows down to 3, then the growth rate overall, half of it is gone. So you will have a significant impact. So there will be a global recession if China crashes. Now, also for Korea, you look at overall export numbers, it's 25% of the export goes to China. So it's also very highly dependent now. So I think that everybody talking about this potential crash of China will be a big issue. But I think that this will not happen anytime soon. The reason for that is because there's a lot of measures that Chinese government can do to sustain the current level of the growth rate. Number one, you have consumers, the consumption, which is only 35% of the consumer debt as the GDP is only 35%. And you can grow that number to maybe 70–80%, which can grow the consumption quite significantly. Also, the government debt is only about 50% of the GDP. Also, they can be able to use that to facilitate a lot of the fixed asset investment, particularly the infrastructure side. So I think that for the time being, the crash is not going to be the likely case. What you really have to think about right now is that the US and China is fighting for who's going to be the next leader of the global economy. So they're fighting over a lot of areas, including IT, the biosector, as well as the alternative energies, electric cars. You put all that together, we call it fourth industrial revolution. Who's going to be winner to that? I think that the chance of US winning is much higher than China, but China would like to win certain areas of it, maybe particularly on electric cars and the alternative energy side. In any case, you always have to look at why are they fighting, which area they're fighting, and who's going to be the leader on next generation in terms of economic growth rate.
Right. Also, about this escalating tensions between the two countries, there are some commentators who say that there will be, we're in the cusp of a new Cold War.
Right.
Right. It's very scary to hear about that. But what is the possibility of this dispute spilling over to really the security issues?
Yeah, I think that's going to be a very unlikely case. The Cold War is the era where there's no connection between countries per se. Right now, we said, who's going to be the leader of the fourth industrial revolution? What does that mean? It's all about Internet on Thing, where you connect people all over the world at a much cheaper cost. So who's going to be the winner on that? If you create a Cold War, then you're not going to be the winner, right? So therefore, I don't think that this is going to go to that direction. The question mark is that how profitable, how competitive will you be in all these areas? The AIs, the electric cars, the automatic automobiles, and all these new areas, the data centers and all that. It's all about connecting. It's all about data. So therefore, I don't think that there is going to be any Cold War. It's more like a putting together more even aggressively. And who's going to be in front of it? So I think that we should not be worried about the Cold War.
Okay, so whichever the sector or industries, let's hope that this trade dispute will subside very soon. Thank you very much for coming today.
Thank you for having me.
The friction between the U.S. and China is unlikely to be resolved in the near future. It remains to be seen whether the world's two biggest economies will continue to butt heads or be able to reach an agreement. That's all we have for this week's The Point World Affairs. Thank you for tuning in and see you again next week.